Robert Arnott, welcome here at the Invest channel. It's not your first time that you're in Switzerland, right?
Been here probably 6 or 8 times in total, twice to Zurich.
And you like it?
I love it. Wonderful country.
What do you say about the actual market?
I have a very cautious view. I think the subprime is only part of the problem. I think what we had was not a real estate bubble, but a lending bubble. A lot of very reckless lending all over the world. And I think we've seen the first few chapters of that book. I think we're partway through a bear market, not finished with it. And I think we're going to see single-digit returns on average in the years ahead, not double.
When do you think the storm will be over?
It depends how you define a storm. I think we're in an era of lower returns. And I think if people expect lower returns, if they plan their future based on an assumption that they'll get 4 or 6 or maybe 8% returns, that planning will lead them to make the right choices and they'll be fine. The problem is the expectations gap, people who expect double-digit returns and who find that they achieve half that.
But that means the happy times are over for investors.
Not really. It just means that one has to be more selective, more careful. One has to be more risk-averse. And one has to plan for the future based on more cautious assumptions. And that's fine.
You are the founder of the research affiliates fundamental index, RAFI. Can you quick explain it to us?
Sure. Indexing has been with us for 30 years. Almost all of the indexed money worldwide, which is roughly 6 trillion Swiss francs of assets all over the world, almost all of that money is capitalization weighted. Now that means that companies are weighted by the total value of their outstanding stock. Nothing wrong with that, but for one problem. It does link the weight, the size of our investment, directly to the error in the price. So a company that's overvalued, we automatically have too much of it. A company that's undervalued, we automatically have too little. We get pulled into one bubble after another. RAFI breaks that link by simply reweighting companies to their economic scale. It's an index that mirrors the publicly traded part of the overall economy, rather than matching the character of the market, which is the stock market's best guess of what the future will look like.
And RAFI was very successful the past last years.
We launched the idea in late 04. Our first live strategies were late 04. 05 and 06 were brilliant. No surprise there, because RAFI does have a value tilt relative to the market, reciprocal to the market's growth tilt relative to the average company, loading up on growth companies. And last year was our first growth year. Growth beat value all over the world. Large companies beat small companies all over the world. So RAFI was flying into a very intense headwind because growth was winning by such a wide margin. So it's very surprising to note that it still won by 9% in emerging markets, by 5% in global small companies, by 3% in global indexes, by fractional gains in U.S. small companies, and took a small 2% haircut relative to the S&P 500 in U.S. large companies. That's a wonderful outcome given a growth-dominated market that will normally help along the cap-weighted indexes because of their growth tilt.
How can a private investor go into this RAFI concept?
I've never seen an idea gain so much traction so fast. We've gone from $100 million invested in the concept worldwide 3 years ago to about $25 billion today. 0 to 25 billion in 3 years is amazing, and it seems to be growing by 1 or 2 billion a month. There are ETFs, exchange-traded funds, already here in Europe. There are 4 on the Paris exchange. There are 8 on the London exchange. There are 4 on the Stockholm exchange. I'm hopeful that there will soon be some on the Swiss exchange. So the idea is gaining very rapid traction. People can access it through ETFs from Lixor, from Handelsbanken, from Invesco in Europe, can access it through mutual funds in the U.S., through ETFs in the U.S., and mutual funds in Japan. It's already being used all over the world.
You never buy single stocks.
I don't. Even as an investment professional, the notion of digging into hundreds of stocks and understanding their businesses well enough to have insights that are better than the market's insights, that are better than the consensus, is very dangerous. And so to my way of thinking, I want to invest in broad markets, and I want to invest in them in a fashion that recognizes that fundamentals really drive asset pricing.
Thank you very much for this interview, Robert. Thanks.
It's been a real pleasure.